You may have seen, and hopefully we'll get this out in the next day or so, you may have seen here on Thursday, April 22nd, somebody at the White House leaked this plan and this proposal that's coming from the Biden White House to double the capital gains tax. And of course, if you notice here on the article from Al Jazeera, which is actually an excellent news source when it comes to U.S. politics, Al Jazeera is reporting, and again, this is leaked, this is not policy, this has not made its way through Congress, but we kind of know that because the Democrats control both houses of Congress and also the presidency, pretty much anything that they want to do for the next 2 years is fair game because Kamala Harris cast the tie-breaking vote in the Senate. So pretty much anything that comes out of the White House, we can kind of assume at this point is going to get done. And Biden is recommending the doubling of the capital gains tax for the rich. And the first thing I want to talk about is this word, the rich, right? I've always hated this word because, one, I feel like it tends to vilify people that are theoretically the most productive in our society. And granted, I know there's plenty of people that are rich that maybe got their money through either a trust fund or inheritance or ill-gotten means, or they had some type of advantage or head start in this world. I realize that. I understand that, but that's not what we're here to talk about. We're here to talk about the capital gains tax rate. And also this idea that, you know, if you scroll down and you read the article, what it ends up saying, and what's probably going to come out on this proposal, is that Biden is recommending this highest tax rate on the rich of who have capital gains, meaning some type of gains from the sale of an asset or a stock or a property. And the income limit here to be taxed at this highest level is earners that are making over $1 million a year. Now, let me be clear, making over $1 million a year in any state in America, you've got a pretty great life. I've never gotten there. I hope to get there one day. I know some coaching clients of mine that have gotten there and made over the $1 million mark. But what I want to focus on real quick is this word rich. You know, it was only 10 or 12 years ago during the Obama presidency where when these ideas of taxes on the rich, or these very high percentages on the rich, were only assigned to people that were making billions of dollars, right? Billions of dollars. So 1,000 stacks of $1 million, right? There was a lot of things floated over this idea of the billionaire tax. And then it was kind of like, well, if you make more than 10 billion, and then it was 100 million, and then it was 10 million. And then when Warren and Bernie Sanders, Elizabeth Warren and Bernie Sanders were duking it out in presidential primaries, it was like, well, you know, maybe if you make over $5 million, you should be paying more of your fair share. And now that Biden is president, and now that we have a majority Democratic Congress in both houses, in both the House and the Senate, now it's if you make over $1 million. And there's a couple proposals on the docket for additional excise taxes and penalties and phase out of certain deductions if you make over $400,000. And so if you just think about how much money $1 billion is, $1 billion is a stack of 1,000 millions. And that within 10 years has gone from, oh, those are the people that we need to vilify and tax more, all the way down to, depending on what policy you're looking at, people that are making somewhere between 250 to 400,000, upwards of maybe $1 million get hit with this highest tax. And I just want people to understand that when you're not guiding from any type of first principles, and by the way, I'm not just blaming the Democrats here because Republicans have completely become absolute hypocrites. And when they're in office, they spend just as much as the Democrats. It just so happens there's a Democrat in office right now. But when you have this insatiable lust to keep spending money and printing money and having bailouts and having more programs, eventually somebody has to pay. And this idea that we used to be able to vilify multi-billionaires and then billionaires and then 100 millionaires and now millionaires and now people that are making a couple $100,000, eventually they just come for more and more and more and more and more and more and more because they have to pay for all of these things that they keep promising, right? And let's be honest, none of these policies are being enacted out of the kindness of these politicians' hearts. These politicians want to stay in power. They need to garner a certain amount of votes, and they are using our own tax dollars to buy votes, right? So if you read into the proposal that got leaked, of course, this extra tax money is going to go to things like probably paying off the bailouts that we just printed a couple but close to $10 trillion in the last year. It's also planning, I think it talked about childcare for all. Yeah. The family plan is set to include a wave of new spending on children and education, including temporary extensions of expanded child tax care. It goes on to say that it's going to be covering all kinds of child care and yada, yada, yada. So what do politicians do? And again, I'm not just blaming this on Democrats, because Republicans do the same thing when they're in office. They decide, hey, there's a lot more parents in America than there is individuals who realize capital gains, right? The number of people, I think Chris and I looked this up the other day, something like the top 10 or 15% of Americans in wealth own like 80% of all the stocks in the country, right? And I'm sure we could find a similar number of the number of people that obtain capital gains through selling additional assets, whether that's art, property, whatever the case may be. So the Democratic Party is doing a really smart calculus here. They're saying, well, we can tax the rich. And again, I qualify that word rich because frankly, if you're in California and you're making a couple $100,000 a year, you're doing well, but you're not by any stretch of the imagination rich. You can basically afford maybe a starter 2-bedroom home on the east side of Los Angeles that now, tips $1 million on the average starting price. I digress from the rich comment. But the Democratic Party is making a calculus here where we can pander to a larger base of voters who are parents or people that get child care credits or whatever the case may be. And we can tax the smaller group of people, which are those people that realize capital gains every year. And I want to go through a couple tax things because I think this is really important for people to understand on taxes and what capital gains tax are. So capital gains tax is effectively you buy a stock for $100, right? You were really smart and you bought Apple 10 years ago when it was $100. I actually don't know if that's the case or not. And then 10 years later, you sell it for $300. You sell that same stock. All right, you bought it for $100, you sold it for $300. And it's important to understand the difference between short versus long-term capital gains. We're not going to get into that here. Let's just assume all for the purposes of this conversation. We're talking about long-term capital gains where you own that stock for more than 1 year, because I don't want to go into the difference over short-term capital gains and how that's taxed, but just forget about that. Assume that everything we're talking about is long-term capital gains. So you buy a stock for $100, 10 years later or 2 years later or 5 years later, you sell it for $300. Your cost basis was that $100. You now realize $300, the spread was $200, and that's your profit, right? So that's what you have to pay capital gains tax on. Now, currently, capital gains rates at the federal level are somewhere between 15 and 20%, depending on your tax bracket and some other things. So let's just assume most people that are realizing capital gains are going to be in that higher income earner. So they're paying 20% currently in capital gains tax to the federal government. So on that $200 profit, 20% of that, $40. $40 right off the top of the money that you gained through capital gains is now gone. It's gone to the IRS. What's frustrating for somebody like me when this type of stuff gets talked about is that in order to put that $100 into a stock account to have it grow and take that risk, because remember that stock could have gone to zero. It seems so unlikely now, but there was a time in the recent past 15 to 20 years where Apple was almost no longer. That company almost went out of business before Steve Jobs took over and resurrected it. So when you put that $100 in Apple, there's no guarantee that stock is going to go up. As a matter of fact, it could go to zero, and you're taking a huge risk every time you invest in an individual company. However, to get that $100, you probably had to earn the $100, right? So let's just go to where the current tax rates are for earnings, because before you put the money in the stock, you had to earn the money. And here is a chart, and we can just go to the computer, go to the screen. Here's a chart of the current 2021 federal tax rates. And this is another important thing. Sorry to talk down to you if this is common sense to you, but a lot of Americans don't understand this. There's a difference between your marginal tax rate and your effective tax rate, your marginal tax rate and your effective tax rate. And for the purposes of this exercise, I'm going to assume a lot of people investing in stock and realizing gains are also part of a married couple. I don't know why I'm assuming that, but let's just pretend, probably because that's my experience. So the married couple, the income you earn up to in this chart, $9,950, that portion of your income is taxed at 10%. Then from 9,951 up to about 40,000, it's taxed at 12%. The $40,526 starts getting taxed at 22%, and so on and so on and so on. So when somebody says they're making $250,000 and they're in the 35% tax bracket and they're married, that doesn't mean that all of their income is taxed on the 35% rate. If that was the case, that would be your effective tax rate, meaning that all of your income was taxed at 35%. That's not true, because in America, we have marginal tax rates where your first roughly $10,000 is taxed at 10%, and then so on and so on and so on. So it's this calculus, this sliding scale, that as you earn more money, the previous buckets of money that you earned, they are taxed at the lower rate. And then once you get up to a married filing, I was looking at the wrong category. Married filing jointly, same example. Up to 20,000 is 10%. Up to 81,000 is 12%. Then it starts to grow from there. So I'm looking at the married filing jointly. Sorry, I got that all wrong. Looking at the married filing separately. Married filing jointly, up to about 19,900, you're at 10%. Up to 81,000, you're taxed at 12%, so forth and so forth. Once you get up to over 628,000, they're taking 37% of every dollar that you make over 628. So I'm going to say in Southern California, if you have two working professionals, they're married, they're filing jointly, they're both either college educated or have done well for themselves in a job. Let's say they're making $220,000. I do a lot of loans. I see a lot of people that are homeowners. Making around that $200,000 mark is where most people have to get to afford a house, unless they have a massive down payment or they're getting gift funds or there's some other extenuating circumstances. But for the most part, to own in a lot of areas of Southern California, you got to be making $150 to $200. So at that 200, 220 mark, the marginal tax rate, the money you're paying on that, is 24% at the federal level. But don't forget, we've got state taxes. And being in California, we have some of the most egregious tax brackets in the country. I think we're currently the highest in the country. Yeah, we are the highest in the country. So that's awesome. Okay, so tax bracket for this same married couple, right? They're making in the 220 range. So everything over $115,000 in Southern California, every dollar you make over $115,000 as a married couple is taxed at 9.3%. Okay. So now the upper limits of your income, and this is anything over 115. So it actually grows much quicker in California than it does at the federal level. But on that money, let's say the topper tier of the money that you're earning, which is probably the leftover money that you have to invest, is being taxed at 24% at the federal, 9% at the state. So let's just call it 35% in taxes. So in order to have $100 left over to invest in Apple, whatever 100 divided by 0.65 is, you have to make about $145 or so. So you have to make about $145 in order to be taxed on it, to then have $100 left over to invest in that Apple stock. Then you invest in the Apple stock, and it grows to $300 in our example. You pay your 20% capital gains tax, and you are left over with your original $100 plus your $200 in gains. You have $300, but remember, you had to pay the capital gains tax, and you had to pay the tax on the first $145 you made in order to get to the $100. So in order to end up with $260, you paid about $90 of taxes. So the government is getting already a huge chunk of the money you're making. And then as you're investing the money, they are going to take it, right? Now, if we look at the current capital gains tax rates, the current capital gains tax rate, I forgot another tax. Sorry. In that whole exercise I just went through, there's the state capital gains tax. So you've got 24% at the federal level when you earn the money. You got 9% at the state level when you earn the money. So you're at about 35% there. Then you're currently at 20% on the federal level on capital gains tax when you invest the money and it grows. And in California, I forgot a tax, of course, because there's so many of them, you're at 13.3% in capital gains. So 35% of the money that you earned goes away to taxes. Then you invest your hard-earned dollars and it grows. And as it grows, if you ever cash it out, you owe another 33% of that growth in taxes. Now think about this for a minute. Biden is recommending that the tax rate go to somewhere between 20% on lower income earners and 39.6% on higher income earners. So let's say you are that vaunted, super rich, evil millionaire who just sits around and counts your money all day because, of course, millionaires have never added anything to society or the economy. Let's assume you're that person. So you made $1 million, right? And let's go back here. You made $1 million, and presumably the upper portion of your income is the leftover disposable income you have to invest. And you're married, filing jointly. You and your wife are crushing it. You're making $700,000, $1 million, $1.2 million, something like that. You're going to pay 37% in federal taxes, and that is for sure going to go up this year, thanks to Democrats. In California, you're making over $1 million, or you're making up to about $1 million. So you're paying 13%, 13.3% in state tax. So already that money that you start to earn over around $1 million is taxed at a 50% rate. Every single dollar you make over $1 million is taxed at 50%. And then you say, okay, well, that's fine. I'm okay paying 50% of my money to pay my fair share. But, I really care about the future of my family, so I'm going to go invest it. Well, now, under Biden's plan, you're going to pay 39.6% of the gains on your investments. And if you're unfortunate enough to live in the state of California, you're going to lost my screen there, sorry. You're going to pay that 13% in California capital gains. So now you are at effectively 53%. 53% of every dollar you earn after you pay taxes on it and then took the risk to invest it, you're paying 53%. But wait, there's more, because don't forget, in order to pay for the Affordable Health Care Act, there's a 3.8% surcharge investment on capital gains for anybody that falls into a certain tax bracket. So you take your 53% that would go into effect if Biden passes this law, you add your 3.8% that they already passed when Biden was the vice president to help pay for Obamacare, and roughly 57% of every dollar that you earn in investment income disappears to the federal government or the state government in taxes. Now, I'm all about people paying their fair share for society, although I think our fair share would be significantly lower than it needs to be if our government was a little bit more prudent. Both parties, by the way. But in what world can anybody with a straight face sit there and say, you know what? Just because you happen to add more value to society, which is generally why you get paid more money. I'm sorry to say that. I know there's a lot of low-paid teachers that add a lot of value to society. I know there's a lot of stay-at-home moms and dads who add a lot of value to society. But generally speaking, if you're making more money, if I'm making X times 2 or X times 3, it's generally because I'm finding a way in the free market to be more productive and create more value or close more deals or sell more widgets or whatever the case may be. So if you become more valuable, I just want to know who thinks it's fair or their fair share to have somewhere around a 50% combined federal and state tax rate on the money you earn. And then when you try to get ahead and invest it, which, by the way, investment has other second and third and fourth order positive effects because you're investing in companies that presumably make America and the world better. Then when you realize the gains on that investment, which you had to take a huge risk on, the stock market doesn't always go up. Just look at 2009. If you realize any of those gains, means sell the stock because now you want to go buy a house, you're paying another 57% in taxes. It's just absolutely asinine. And to further stack the deck, if you lose it all, you can write off $3,000 a year. So think about this for a minute. You invest $100,000 in Apple. You invest $100,000 in Apple, which means you really had to earn around $145,000 to pay the taxes on the earnings to then have $100,000 left over to put into Apple. Apple goes to $300,000. That $100,000 investment goes to $300,000. Under the old rule, the old federal and state tax rates, on that $200,000 of gains, you'd pay about $66,000 in taxes. Under Biden's new proposal, you'd pay about $114,000 in taxes. So you earned the money, you earned 145 to put in $100,000 post-tax dollars into the stock market. You invested in Apple because you believe in the company. You scored right, you invested well, the company did well. Your $100,000 went to $300,000, and now under the new plan, when you cash it out, you could pay up to $114,000 in taxes, more than 50% of your investment gains after you already paid somewhere between a third and a half, one third and one half of your income tax just to get the leftover money to make the investment. However, and here's the real kick in the nuts, if that $100,000 in Apple goes to zero, so tomorrow we wake up and we find out that everything Apple's ever done is open sourced, or they ripped off all the code to Samsung from Samsung, and Samsung sues them out of existence, and Apple stock goes to zero, and you lose $100,000. You know what you can write off on your taxes? You can write off $3,000 a year for the next 33 years. So the government has set this up where you pay an unlimited amount of taxes on any gains. And if you lose, if you invested incorrectly, or the company misled you, or the stock market does poorly, or you just lose all of your money, the maximum amount of capital loss that you can write off every year is $3,000. Now, that will carry over indefinitely. So in this example where you lost your $100,000 in Apple, that left you totally, snake bitten, and you decide you never want to invest again, so you have no other future capital losses or capital gains. It will take you 33 years to write off your $100,000 loss, $3,000 at a time, because the government wants all of their money on your earnings. They don't want you to be able to take your losses on stocks and write that off against your earnings. So you're just stuck writing off $3,000 a month, or $3,000 a year, excuse me. And so, not that I'm condemning any type of stock manipulation or securities fraud, but can you kind of understand how when people get caught trying to manipulate the stock market and manipulate things, can you kind of understand why they would maybe do it? Because if we live in a rule where the tax laws are such that you have an unlimited tax liability on the upside, but if on the downside you can only write off $3,000 per year, it kind of creates a structure where you're encouraging people to cheat. You're encouraging people to have insider information because they can't write off their losses if they have a big loss. Now, there is some ways that you can do that. If you have capital gains, you can write off carry forward losses. So there is some offsetting mechanisms if you have a big score in the future. But if you're just a normal investor who doesn't really understand this stuff, you kind of get screwed. And if you're in Southern California and you're making what you think is a really good living of, $200,000, $300,000, $400,000, $500,000, remember what I started this section on. They've gone from attacking and vilifying the people who make 10 billion to a billion to 100 million to 10 million to a million to 400,000. Eventually, they're going to find a way to come for you at any tax bracket because they're buying you with your own, they're buying your votes with your own money. So they keep giving out free shit, which isn't free, and then saying, oops, guess we have to pay for that, so we better come up with some new taxes. And the idea that they're throwing out this number of doubling it, it's kind of like in that book, Never Split the Difference by Chris Voss. It's an extreme anchor, because if you think about our whole capital system, our whole investment system, long-term investors that have thousands, tens of thousands, hundreds of thousands, hundreds of millions of dollars in the stock market, part of their calculus on keeping money in the stock market was this thought of like, all right, well, what are my taxes when I see some gains? So I personally think what this is, and we'll see if I'm right. I think what this is the White House intentionally leaked this plan showing this insane number of 40% capital gains tax, which with the Obama surcharge of 3.8% really takes it to 42 and something. I think they released this to scare the shit out of people so that when they come back to the table, they basically set the anchor now, this extreme anchor that's way out there. When they come back to the table and say, well, no, we're only going to tax you 25% on your capital gains, everybody will just say, whew, thank God it wasn't 40. And they'll go forward with it as if nothing ever happened. And sadly, the calculus will still remain the same because you're paying taxes to get the money to put in the market. Then you're paying taxes on the capital gains. And it's just crazy. And the fact that this is something that they can just, by throwing out the word tax the rich, by the fact that they can garner public support by just saying, oh, we're taxing those evil rich people, and they can get these kind of bill passed, just shows how ignorant Americans are when it comes to the tax code and what's really going on. Now, instead of just complaining, I do want to offer a solution. And this solution came out of the 2007 tax cut bill. I thought this was a genius solution for how you could kill two birds with one stone. You could satisfy the more left-leaning wing of the voter base or of our government or politicians by helping low to moderate income people. And you could create a financial incentive that circumvents this whole capital gains dilemma. And it was called economic opportunity zones. Economic opportunity zones is actually something Obama pioneered in a small way. And then it became part of the 2017 tax cuts. And it basically goes like this. You can look this up on a map. Just Google economic opportunity zone maps. And you can see all of the areas that have been outlined in America as either socioeconomically depressed, underdeveloped, low to moderate income housing areas. And what this does is this allows investors, hedge funds, business individuals to go into these more downtrodden neighborhoods or neighborhoods where the average median income is significantly, or the average income is significantly lower than the average community or state or country median income. I don't know exactly how the formula works, but basically you go into zones and you go into communities that are hurting, that are economically depressed. And there's all kinds of caveats. I don't claim to be an expert on it. However, what it does is it encourages investment, because if you put your investment dollars into these economic opportunity zones and you leave it there for a certain amount of time and you can show a certain amount of growth or job creation or whatnot, they will allow you, when you sell that asset, and I don't know, again, exactly what the law is 5-10 years later, when you sell the asset, you don't have any capital gains. So I'll tell you a real life example of how this worked out. A friend of mine invests in storage units. He's world class at, he actually has a bunch of training programs on it. Maybe we'll put the show notes down or we'll put his link down in the show notes. He's great at developing and identifying underserved assets or underperforming assets in the storage unit arena. So what he did was he was about to sell a property that had huge capital gains implications. I mean, he bought it for X. He was about to sell it for 3 times what he bought it for, and he was going to have a huge capital gains bill. So his options were, all right, well, I can pay the capital gains, take the money, put it in my savings account, go on with my life and have a nice chunk of money to live off of for a substantial amount of time. Or if I don't want to pay taxes on that, what I can do is I can roll over the entire sales price of the storage unit that I just sold. I can locate an economic opportunity zone in a struggling community, and I can reinvest my money there. So instead of just taking his ball and going home, he reinvested in a, more depressing sandbox a little bit down the street. And he ended up finding a huge project that he could convert into storage units. He financed the construction, the conversion, employed people in the local economy. It now created jobs because there's people on site that run the storage unit. And instead of just selling his asset, paying his taxes, taking his money and going home and living off of it, he decided wow, there's this huge tax savings and I'm going to be forced to pay this huge tax bill of, 20% at the federal level and 10% at the state level. Instead of seeing 30% of my profit go, let me find a neighborhood that needs some investment where I can pencil out an investment that makes sense for me. I'll dump my money into that. I'll build up the community. And then the trade-off for him taking that risk as a business owner with his own capital is the IRS says, whatever the law is, 2 years, 5 years, 10 years, I'm not quite sure. When you sell that asset, you no longer have to pay capital gains on the money that you realized from the initial investment. So huge win for him in tax savings and structuring his finances. Huge win for that community because, again, created jobs, took a dilapidated property and made it, basically a city beautification program where now it's a functional, nice looking building in the community, which then in turn creates more investment opportunity, draws more investment to the area. So it's a win-win. So I'm not just bitching and saying that there's no way to deal with these kind of things, but the idea of just overnight or in one tax year, doubling the tax rate on capital gains, it's a recipe for disaster. It's a recipe for people to pull their money out of the stock market and have a downward spiral. And it's a recipe for people to do even more shady shit in the world of finance and high finance and stock market manipulation because their tax rate is so high, they have to set up an unfair advantage where they win. Remember, because if they lose, they can only write off $3,000 a year. But if they win on any of their gains, they're going to pay over 50% of those gains to taxes, which is just insane because they already pay taxes on the money when they earn the fucking money. Anyway, I digress. I'm starting to yell and scream and sound like Alex Jones.